Yes, in case you may stumble upon this video, please watch it to the end. Your eyes will be open, though the video is a little bit long due to the natures of the topic which I title it Understanding Time Frame Liquidity in the Market. So because of this topic, theoretically I explain it a little bit before I go into the practical. So let's go to the chart. So in today's lesson, I'll be teaching you a topic called understanding time frame liquidity in the market. I've taught you about time frame differences in the market. See, every time frame in the market have a liquidity behind it. Assume that we are trading 4-hour time frame. Like, before I go into the topic, let me explain this. When you are trading, you have to identify the time frame that you are trading. Stick to a particular time frame that you are trading so that you will not get confused. See, your time frame is directly proportional to your patience. Like if I'm trading with daily time frame now, that means I have to be patient. I have to be patient. When others are entering markets, I might not be entering my market because it's not yet my time. So that is how it is. Now let's go. Assuming we are trading with 4-hour time frame now. This is 4-hour structures, right? This is 4-hour structures. Let's stick to 4 hours in this lesson now. This is 4-hour structure, right? Okay. And one thing again that you need to understand, market is just like two-edged sword. One trend give birth to another trend. So the previous trend that give birth to the current trend, you need to concentrate on that trend, because anything that is happening in the current trend is directly proportional to the previous trend. You get? Is directly proportional to the previous trend. The current trend is reacting toward the previous trend. So anything that you are doing with the current trend, you need to tap into the previous trend. Like this is what I'm saying. Like now, we have a trend moving from here to this very point, and it begins to reverse, either reverse or retrace. So anything that is happening around this retracement site is directly proportional to this trend. Is directly proportional to this trend. Do you get? So this trend does not exist on its own. It does not exist on its own for now. As far as this trend is concerned, this one is still directly proportional to this one. Do you get it? Okay, now understand that. So let's go to the main this thing. So if you look at this previous trend that is giving birth to the new retracement now, we see a break of structure or change of character around this place. Around this place, you see. Now I want to explain, there is a liquidity that was taken up there. Do you get? So now, as a newbie trader now, you come here, you say that, wow, this market have break this trend, resistance down, right? You are expecting, or you are waiting to take your market from the resistance. When the market retraces back to it, then you shoot it down, right? That is the general knowledge. That is why I say forex is deeper than a general knowledge. If it is all about general knowledge, everybody would have been doing well in this forex industry. Forex is not a general knowledge. It's a personal or self-discovery. It's a self-discovery. So people that enter around this place, they have become a liquidity to the big organizations. So what they will do is that they will push this one candle alone have stopped out so many people in the market. It have stopped out so many retail traders. Let me just view it very well. You see this one candle, it have stopped out. Let me just say, yes, that's fine. Okay, this one candle from here like this candle, from here, this candle alone, it have stopped out a lot of retail traders in the market already. Orders have been stopped out there. Orders have been stopped out there. So many orders have been stopped out there. Yes, that candle alone has stopped out so many orders there. That is liquidity. So big organization just use those candles to stop out retail traders in the market. Now we have seen a red candle printing out now. As a professional and experienced trader, those are the areas that you need to focus most. Now, let's go back. No, not yet. I'm trying to make this video short, but due to this topic, this video might be long a little bit, because if I'm to explain everything in this video, it's going to be long. So let's go back to 1 hour time frame and see, then it will be well clear to you. Can you see? Can you see? This is the liquidity that I'm talking about. In this place, there's some money that are stored here. Let me show you. Yeah. In this place, see, this place, there are some money that are stored there. So big banks or organizations are trying to go and collect this money where this cycle is blinking here. They want to go and collect this money from here, because there are so many orders around this place, around this horizontal line. There are so many orders, people placing orders that, okay, this market have bounced up down here. So a lot of people have placed order here. Orders have been placing around this place. Orders have been placing around this place, around this horizontal line. So this horizontal line alone is money. So what smart monies or big banks, organizations do is that they'll push this market up small and wipe out those liquidity and take them as liquidity. Then they'll drop the market down. They'll drop the market down. This thing doesn't just happen as a coincidence. If you understand the technique, there is a way you can trade with it. It's aligned with the time frame. It aligned with time frame. It aligned with time frame, because the reason why I say it's aligned with time frame is that coming to 4 hours here, okay, let me just 1 hour here, we have a double top here. Do you see? Do you get it? But on 4 hours here, there is no clear double top on 4 hours here. The down horizontal one is the 4 hour, while the upper one is the 1 hour. Do you get? So all these people, they deal with patterns. Do you get? Okay, so that is that. Let's go back to 4 hour time frame and see. So let's go back. So like this now that the liquidity have been taken out, now that liquidity or some orders have been taken out, what you do is that you wait patiently for this red candle that is coming down to print down again. Coming to this place, you have gotten what? You have gotten a double bottom. Let me show you clearly. You have gotten a double bottom around this place. At this place, you have gotten a double bottom here. Can you see? You have gotten a double bottom from that dropping. If the market eventually drop down, yes, this drop down from here, instead of it to bounce back from here, it goes up small. Then you wait and drop it down here. Then goes up a little bit again. Now it have started creating lower high and then lower high or lower low. Do you get? Is a sign of trend. Is a sign of downtrend already. So once it touches here, this is your entry point. Then you begin to come down. This is how to trade time frame liquidity in the market. When you are trading with, like for example, you are trading with let me just say 4 hour time frame. You are entering 4 hour time frame. Before you enter 4 hour time frame, you need to view it back to 1 hour, because because the lower time frame of 4 hours is 1 hour. I've taught you people that before. Go to my YouTube channel, you get to know about this better, because I've taught you people about time frame difference and time frame proportionality. I've taught you people that. So go to my YouTube channel and watch that before you come here, so that you understand it better. So I don't want to prolong this video. I'll still extend some part 2 of this topic again, so that I can teach you how to identify the time of which, let me just say, the time of which the liquidity will be taken out before you enter the market. So I'll do that in part 2. So this is part 1, because I don't want to prolong this video more than this again. So if you are new in this channel and you like this channel, you like what you're seeing, you like this video, consider subscribe to my YouTube channel, like,